Hello, welcome back again. So I was taking a look at Dollar General. Some people suggested that in our comments, in our channel pretty much. And Dollar General is actually very interesting. And I was taking a look at the financials of the company and examining it in more detail for my video. I thought that this could actually be a really interesting buy here. It did look cheap. But I wanted to give you the full picture here, and I will start with using our tool here and taking a look at our news module. And obviously all our patrons have access to the tool, and you can become a patron by visiting the link in the description box below this video. But you will notice here some discussion about Dollar General, and this is all articles about Dollar General here in this specific module. And you will see that some articles are talking about pretty much rebounding, whether it's a buy, a sell, or a hold. But what has actually happened? So what the heck is happening with the Dollar General stock? Why is it down so much? And you will see that margins are compressing along as same-store sales growth stagnates, which is always a bad thing to see. The company may finally be seeing a greater threat from e-commerce competition. And the stock looks cheap, but a lot is riding on Dollar General profit margins this decade. So understandably so, the sentiment around Dollar General has grown pretty negative, and this is why the stock price has been suffering. And again, we can take a look at our metrics page here and see the details about its downfall. And taking a look back at 6 months, you can already see how far down it has fallen. Or about 1 year, same thing. And it's a little bit unexpected too, because amidst the market where interests are rising and things are getting more expensive overall, a company of this sort should usually go higher. And it's a little bit unexpected here that they are actually heading downwards and down and down and down and down, which has two interpretations, frankly. One could say that the company is doing really, really bad and they could potentially keep going down and potentially bankrupt or whatever, really continue going down. And somebody else could say that this can eventually get to be a really, really interesting purchase in the case where the whole economy goes into a recession, and then this could really, really boom over here, Dollar General, that is, especially starting off of a low price. And it is really a low price. I mean, if you take a look at the 5 years chart, you will see that we are sitting pretty much close to the lowest the company has been since 2019. So a massive decline here for the stock, making it interesting, obviously, for investors, as it's down almost 56% since its 1 year high. Now, the P/E ratio of the company is sitting at 11.7, going down, which is what we love to see. Obviously, the lower the better, because it's more valuable, it's worth more for the same price. And the price to free cash flow is sitting at 60 here. It's a little bit more elevated after the adjustments. Obviously, you would like this one to diverge a little bit, to be similar actually, and not diverge that much. And outstanding shares the company has been buying, which is obviously a nice thing to see, yet it hasn't really caused an effect. Again, it has actually dropped the stock and kept dropping pretty much. So there is a lot of selling pressure over here right now as of the making of the video. But this could easily, the sentiment could easily change if something happens, especially in the overall economy, of course. Now, a bad thing that I didn't really like here is the total liabilities compared to free cash flow. They are very high. The company's total liabilities are really, really high, although the cash flow is not impressive either. But also, the debt to equity is really high too, 3.1. It's getting to dangerous territory and it keeps increasing. So the company has added a lot of debt. And that can be the death of a company, especially if their margins are going down and if their net income is going down. This is basically the prime reason why a company can go down. Having a lot of debt without being able to repay that debt is why companies go bankrupt. So this is high risk here, and this is one of the core reasons why the stock has been going down and down for a while now. But let's take a look at the finer details, like what this means exactly. And also, the other thing, the net income margin is also down, which tells you things about the profitability of the company, pretty much getting suppressed against something that we really, really don't like to see as we're potentially entering this company, obviously if we already own this company. And it's paying about a 2% dividend yield right now. Now, the income statement of the company, you will see they did have 25 billion in revenue. Right now they're having 37. So they have been growing. It's not like they have been stalling in regards to growth. Their net income from 1.5 to 2.4 is much less growth here, but still growing at some pace. But it's not like you would expect this company to keep growing at a tremendous pace. And this is another concern here. They seem to have stalled in regards to growth. Again, you will see like last year minus 10%, and with the margins having dropped as well, the company has been at a little bit of a negative sentiment here for a reason. And the balance sheet is interesting to see because of what I talked about earlier. Take a look at the total liabilities that the company has here. They are sitting at $23 billion, $23 billion total liabilities, and the total equity is sitting at $5.5 billion. So much higher in regards to total liabilities, and also the total debt, 17.6 compared to 5.5 is about 3 point something that we saw earlier, if you do the division. And so, the company has quite a few liabilities here in debt compared to the equity that they have. Also interesting to notice. But sometimes this may not be a huge problem in some cases when it's done on purpose, like Apple has been doing, but it's a different story. And also, if the company generates a lot of net income and a lot of cash flow, obviously they can repay their debt and not have many troubles. This can be okay. But is that the case here? So, with a net income of 2.4 billion here, you will see that after the adjustments, we're getting operating cash flow of 1.9 billion, but capital expenditures are very high, 1.5 billion. And so, if you take it down, you will see that the company generates a measly $424 million in free cash flow. Again, you can say that this was for one year though, because the previous year was 1.8 billion, and we can examine it because they actually had a similar net income, and you will see that they just had more operating cash flow is the core reason why this has happened, and this can sometimes be due to inventory, things of that sort that can actually affect the cash flow. But it's worth noting that the company's cash flow is pretty much about the same in regards to growth when compared to the net income of the company. But again, if you take it to like 1.7 billion, you will see that it's a little bit better. So 1.7 billion, and we take it back to our balance sheet, and you will see that the company had about 17.6 billion in debt. This is about like 12 or something of that sort in regards to the division. Like if you do the division 17.6 divided by 1.7, for instance, which is the free cash flow that they generated 2 years ago, you can kind of see here how much of their cash flow they would have to dedicate in order to resolve the total debt issue. And it's a little bit troublesome because if you take it back to 2018, you will see that the total debt of the company back then was 2.8, and then it rose massively. And this I don't like to see, and it kept rising. It's not going down at all. You will see the total debt growth here that the tool tells us about: 308, 16, 4, 23. A little bit of a scary situation here, I have to say. So you have to be careful here if you are looking to enter the company. But what about the valuation? I mean, sometimes we have risk, but this risk you can actually account for in regards to the stock price. Like if something that's very cheap here, it may be an interesting case. And so the revenue growth of the company typically is about 10% the last 5 years. You can kind of see the exact details here. So I will go 6, 7, and 8 for my projections here. And obviously, all our patrons can try their own projections as well. And net income margins that I'm going to be using, you'll see that it is fairly typical, 6 to 7%. It hasn't dropped that much, actually, apart from the last few quarters. But in regards to the annual one, it's about the same. So 6, although there are fears for shrinking, as we talked about earlier, 6.6, 6.7, 6.5, and 7. And free cash flow margins, 88%, 84. The average is about 74%. So I will go, let's just go 70, 80, and 90, I think makes sense. And 13% for our annual return is the one that we typically ask for in our discounted cash flow model. Obviously, you can ask for more or less. This is a case where you could actually ask for more because there is more risk here. It would make sense to ask maybe for 15%. We can do that as an example here after I hit calculate on the first one. And you will see that with these projections, we are solidly green here, which tells us that the stock is cheap. That's for sure, compared to the cash flows that it generates, that is. But again, there are the concerns about the debt, there are the concerns about the suppressing margins, things of that sort. So it's not like this comes risk-free. And if we ask for 15% here for our troubles, because we're potentially entering a riskier case here, then this becomes marginally red, although close, and 140 and 176 still solidly green here for the most part, and still a buy. And so what you are seeing in this case for this company is a company which is a potentially risky purchase with a potential very high upside. If things continue to do well for the company or they go back to their normal. And so it's something that obviously its investor would have to think of for themselves and decide whether they like this case or not. In my view, this is interesting if we potentially enter a recessionary environment, like if we enter a full-blown recession. This is a case of a company that I could easily be looking to enter in my portfolio, because again, these kinds of companies tend to thrive when we're having such environments where people are looking for cheap stuff and things of that sort. So yeah, tell me what you think. Leave a comment below. Is this a buy for you right now, or you're gonna be waiting? What do you think about this one? Interesting case. Thanks for watching, guys. I'll see you soon. Bye bye.